All right, well, with the tightening of risk of the macro space, much of that money flowing into crypto has begun heading out of the same door. Interesting to see whether that mood, though, is shifting. In the wake of, obviously, the fall of the Terra Luna, keeping the negative crypto sentiment in the headlines. Let's get more on the crypto space and more broadly what's happening in DeFi. Matt Harry joining us from DigitalX. Matt, good to see you.
Good to see you, Andrew.
How would you describe what's been going on in markets, certainly over the past week or so? Appears as though their sentiment is actually improved somewhat.
Yeah, I think so, and I think that's been partly led by the traditional space and equity markets. I think the recent crypto capitulation wasn't entirely unexpected, nor was the mechanism via which it was triggered. But you've got to remember here. I think at times like these, often there's a bit of the traditional space engages in a little bit of Schadenfreude, perhaps, when crypto takes a hit. But there was real investors that lost real money here, and we take that very, very seriously. But thankfully, it appears that we're finding some sort of a base. We've had a reset on sort of momentum indicators and leverage across the crypto space to levels that are generally more associated with at least corrective bounces, if not longer term or macro bottoms. We've also seen, as I said, equities find a bit of a footing in the NASDAQ and SPY. Hitting kind of key support levels. And the dollar index backing off a little bit as well. So that all bodes very well for crypto at the moment, particularly given that, during these times of extreme risk off sentiment, crypto's correlation with equities really spikes, and we have seen that this time around. So the traditional market's finding a bit of a footing, bodes well. It seems that, after all that selling around the Luna collapse, it seems that slightly more positive sentiment is returning.
What's going on in that space? Let's talk about stable coins. Luna, yep. They've tried to reboot it in another form, 2.0 if you like.
They have.
No one's buying it, are they?
I wouldn't say no one's buying it. Surprisingly, yesterday evening it rallied 70%. So what they've done is, as a way of making some kind of reparation with the community, they have done a Luna fork and they've airdropped a new Luna token to previous holders of UST, previous holders of Luna. At the moment, it remains to be seen whether the community will adopt the new Luna token. Certainly some of the dApps that were previously building on Luna have moved away and out of the ecosystem. So whether it holds value over time, I don't know. But certainly, if you are holding UST or you're holding Luna, you would be relatively happy that at least there's some activity happening in terms of reparation. Having said that, generally holders of those previous tokens are only receiving around 10 to 35% in equivalent new Luna tokens, and they're locked up investing schedules out to sort of 2 years. So not ideal, but something for the community.
What does it say more broadly though fundamentally for those algorithmic based stable coins? Because that has been brought into question, hasn't it?
Yeah, absolutely. And look, rightly so. You really want a stable coin that's backed one-to-one with US dollars or Aussie dollars or whatever the case may be. So, USDC is verifiably backed one-to-one with US dollars. Those dollars are held in licensed deposit-taking institutions in the United States, and they're all audited. So there's not that same level of risk. Whereas some of these algorithmic stable coins, there can be quite a faulty mechanism around how they're pegged to the US dollar, which was the case with UST and Luna. And it only takes one evil genius, as our CEO Lisa Wade likes to say, to figure out that there's an opportunity to manipulate and kind of drive these things into a downward death spiral to completely destroy or annihilate any value in those tokens. So part of our job as stewards to investors in this space is to make sure that our investors aren't getting tied up in such things. We have identified another potential death spiral with an algorithmic stablecoin on a top 20 asset as well.
Tron.
At the moment. Tron, the TRX token. So their stablecoin is USDD. Unfortunately, it looks like a straight cut and paste from the Terra and UST debacle. So again, people are tying up capital in USDD, hoping to achieve these or earn these 30% annual percentage yields, which are just completely unsustainable. But within that, within the pegging mechanism, it's exactly the same situation as Tron. So it's not a matter of if, it's a matter of when. So those degenerates that are tying up capital in this thing looking to earn 30% per year, they have to know at some point this thing's going to tank and it's going to take Tron with it. So a very dangerous game, and we will stay away from both of those, that stablecoin and the Tron token.
So what do you make then of, and I was just mentioning that news there with Tether in its stablecoin, which is based on real assets, but of course it's very reluctant to disclose in fact what they are. Why is that, do you think?
Yeah, look, it's a good question, and the fear, uncertainty and doubt, or FUD as we call it in the industry, around Tether is nothing new. Since I've been in the space since 2017, there's been a lot of discussion around this. Certainly people that I know that are close to the wheel believe that it is mostly backed. It is backed with commercial paper and things like that. Initially they had said that it was backed 1-to-1 with US dollars, but they've come out since then and said actually the constituents of the backing are A, B and C. But there has been some lack of transparency, so greater regulation or some kind of forced disclosures from regulators in relation to Tether would be really welcomed by the broader market.
So you're saying DigitalX, I mean, you know those ones that you're avoiding,
yes,
and you're warning investors. What then is, what's your high conviction in terms of investment then? What are you looking for? Is it perhaps a combination of liquidity and that real use case?
Yeah, exactly. It's organic use case. So as you said, you know, we undertake high conviction evidence-based investing. We restrict our investable universe to the top 20 by market cap. The reason we do that is that the evidence is showing us that the institutions are now starting to realise something that we've known for a long time, and that is that basically at an individual project level, the entire market is being built on top of those base layer protocols that exist generally within the top 20 to the top 30. So you've got real organic demand, you've got deep liquidity, and because those builders that are building on top of those base layer assets have to pay fees to do that, you've also got revenue generation. So there's real dollar value accreting to those top 20 to top 30 tokens. So they're less speculative, higher liquidity, organic use cases. So we find the investable levels of risk around that portion of the market far more attractive than sort of smaller cap, low liquidity individual project level investments.
You talk about institutional adoption locally, CBA and its crypto app. That's been delayed. Why is that? And in fact, we heard from Matt Common at a CBA just over the last couple of days. Do you get the sense perhaps that they're treading even more carefully at the moment, obviously given what has just happened over the past month?
Yeah, look, it's always difficult to get real transparency when regulators and really commercially sensitive things are involved, like as is the case in this particular instance. I don't think it's unusual for traditional financial system players to kind of change their tune a little bit at every bump in crypto volatility. You know, they all want to get in when it's at the highs, but they don't want to get in when we see a pullback. But that's just been the way crypto has been for the past 12 years. So specifically in relation to the CBA thing, it appears as though ASIC has put the brakes on it, at least in the short term. It also appears that it may have to do with the new RG274 design and distribution obligations. So ASIC basically makes sure that financial product developers are targeting a market effectively and distributing products effectively. So it seems that they may have had some questions around how CBA was approaching their product and their market of 6.5 million app users. I think it happens eventually, but I think it's just a really good sign that the regulators are taking things seriously and they're engaged and they're being careful about how they open up this asset class to smaller investors.
How are you seeing the regulatory development here in Australia, particularly because now we've got the new government?
Yeah.
Are you hearing any particular noises in that regard, particularly I guess also off the back of the Bragg report from last year? Are those findings and recommendations likely to be picked up?
Absolutely, and there's a lot more work going on around those. And in terms of the new government, the Labor government flagged their intent to continue to push Australia forward as a technology innovation economy. They flagged a $1 billion Australian dollar investment fund to do exactly that. And they said they'd look to create 350,000 new tech jobs by the year 2030. So there's clearly the intent there to continue along this path, and certainly the work that was done by the Bragg Senate Select Committee last year set a really good base for that. We're now coming back to industry with the CASPA paper, it's known as Crypto Asset Secondary Service Providers. So it's a consultation with industry, which we've contributed to at DigitalX over the past couple of weeks, which will take the work that the Bragg Committee did and look to actually institute it, put it into play. So they're asking industry participants, okay, how do we actually do this? The two major elements to this particular consultation paper are that they're looking to create a licensing regime, and they're also looking to, so that they need to kind of establish whether crypto is going to be self-regulating. So like a body like Blockchain Australia, for example, having a code of conduct that they oversee, or whether there will need to be specific legislation. The other side of what they're looking at is a token mapping exercise. So there's 20,000 tokens. This is a huge job, but at the end of it, they'll be looking to see whether existing tokens are considered financial products, and therefore they're under the auspices of ASIC and the Corporations Act, or whether they're non-financial products and therefore they fall under the ACCC and consumer laws. So really important piece of work, and definitely all moving in the right direction still.
So in the absence of all-encompassing regulations, and to that point, I guess, legislation, investors who are retail investors,
Yep,
who are looking for some safety there, I guess they may well turn to an ETF. Now, we've just seen a 2 or 3 debut
Yep,
locally to what must be said is a lukewarm reception.
At best.
Didn't come at a great time, of course, given the turmoil of May. What's your broader reading of the appetite for ETFs in Bitcoin and Ethereum at this point?
Yeah, I think it was really disappointing for 21 Shares and Cosmos Capital,
Yep,
that launched those ETFs after 5 years of pushing and fighting the battle. That they fell very, very flat the first few days. I think across all of those ETFs, they did about $1 million Aussie dollars in volume, and volume since then has continued to be really underwhelming, in the order of tens of thousands Australian dollars a day. Like very, very underwhelming. One of the problems with these particular ETFs is the huge margin requirements for ASX Clear. So what they've set up is a system whereby if a broker is marketing these ETFs to retail investors, the broker has to sit with the clearance house a 45% margin on the Bitcoin ETF and a 50% margin on the Ethereum ETF. It's just not practical.
Yeah, it's huge.
It's just not practical. So, you know, enthusiasm understandably has been a little bit lackluster. The other thing to consider is that, you know, these are single asset investment vehicles, and the whole reason in my mind that you purchase an ETF is to get direct exposure to diversified assets. So in terms of the poor old retail investor, he's kind of missing out on a lot of the alpha that can be captured in the high growth portion of the market where we play. But look, it's a stepping stone. It's a step in the right direction. I think over time, as those margin requirements come down, I think we'll see greater uptake from a retail perspective.
Yeah, I mean, but that's the problem at the moment, isn't it? That those retail investors don't have access to those
Correct.
wholesale funds such as your own. But I guess that may well come when you get the regulation.
That's what we're hoping for.
Yeah,
Yes, absolutely.
you keep pushing.
That's the end game. We would like to be able to provide the type of products that we provide to the wholesale market into retail as well at some point.